Ongoing turmoil in the global financial markets has caused the sharpest single fall in UK manufacturing confidence for 28 years. Tough measures to get credit mean many firms will be cutting back. According to the CBI, orders have declined at their fastest rate since 1999 as domestic demand fell.
I think this survey shows that there has been a significant shift in levels of activity and levels of confidence in the manufacturing sector relative to where we stood back in the summer. Until recently, the manufacturing sector, amongst those in the UK, had been holding up really quite well, had proven resilient to the domestic-based downturn, but is now starting to show greater signs of stress. The downturn that we've seen, which has been one of the sharpest falls in both orders and output for quite a considerable number of years, is, if anything, expected to accelerate over the course of the coming quarter. So we do expect that the economy as a whole will be tipping into recession over the course of the third and fourth quarters and through the winter.
The export market has also fallen. Investments have been weakened and employment is set to rise. But the CBI says there are early signs of an economic recovery and predicts the recession is unlikely to be as bad as those experienced in post-war Britain.
There's some very tentative signs that, if anything, the markets are starting to defrost. It would be wrong to expect these markets to spring back into life, but what we've already started to see, I think, are some very small falls in 3-month LIBOR rates, which are probably the most indicative of how the market is acting, and rather faster falls in the overnight LIBOR rates. We're also seeing significant declines in the credit default swap rates, which are a measure of the stability of the banking system. So overall, in terms of those money market interest rates, there are some very early signs that, if anything, the market is perhaps starting to shift in a way that hasn't been evident in recent weeks. And anecdotally, from the banking sector, it does seem that the mood has started to change relative to where we were before the government intervention packages.
Inflation has also started to slow, and there are calls for further cuts in interest rates over the next 3 to 6 months to help boost the economy.
We do think that the inflation outlook is starting to improve quite dramatically. Inflation will be falling quite sharply over the course of 2009, and that does mean that we can look to the Bank of England to make significant cuts in interest rates to help boost confidence. The government is also looking at other fiscal measures, which many of which we're working with them to implement, support for small businesses and bringing forward some of their capital spending plans, and I think those will both provide some help. But perhaps the most important single element has been to ensure the stability of the banking system, to ensure that money can flow and that corporate sector companies can get capital through the banking system to ensure their working capital and investment needs. And so far that does seem to be working.
Looking forward, it's felt UK industry is strong enough to survive the ongoing financial crisis.
We are clearly very competitive. We have seen significant improvements in competitiveness in recent months as a result of the fall in sterling on our export markets, and as a result I think industry is well placed to ride through this downturn. It's going to feel very chilly over the course of the next few months as the economy slides into a shallow recession, but we should be looking towards the eventual recovery, and I think British industry is as well placed as any to benefit from that when it comes.
The CBI predicts that even though times are tough at the moment, the strength of the British economy and the measures being taken by the UK government will ensure Britain weathers the storm and emerges economically stronger.